All right, so we're going to do a macro outlook, and we'll start with the Euro-dollar futures. So Euro-dollar futures, the curve is inverted heavily, and it's hedging that's represented here against uncertainty and just negative things they see in the market. The market participants see in the market with either proprietary information or speculation. But it is hedged heavily from these contracts and then bottoming in 2024, 2025. And then the yield curve percent inverted is roughly 70.9% that we see right here, 70.9% inverted. So the economy is sick, and there's a high chance of, I don't know, a recession. Obviously, I don't know. The idea has lost its meaning, and no one really knows what it means now. Recession or just when these things invert or when the economy is sick. As far as reverse repo, I put a fib here for the. Basically, reverse repo is the view from the lender. So the higher the yield from reverse repo standpoint, the more hedging from the lender is occurring. And we're seeing that lenders are afraid, and they're so afraid they made a second standard deviation higher than the COVID 2019 nuke, or 2020 nuke, but 2019 high for fear from the reverse repo side, the lender side. SOFR, we are at a zero spread between reverse repo and SOFR. Comparatively, reverse repo to the 10-year is a -2 on the spread. The 2-year minus reverse repo is actually gone negative on the spread. So that means reverse repo is actually more safe and liquid than the 2-year. So that's the degree of how sick we are. We are so sick that the 2-year doesn't match the reverse repo, and it's forcing lenders to go to reverse repo instead of the 2-year. And it's just how sick things are. Is that the reverse repo is safer than the 2-year? Now let's try the 3-month. Oh man, U.S. I guess G bill is the best one to do. All right, we'll go with T bill. Oh, what did we get there? Yeah, that's just T bill. I don't know what this data says. I mean, that's kind of why I wanted like a 3-month. Yes. There we go. US 03M. And I mean, it looks pretty bad. We're negative on the spread from the 3 month in reverse repo. So I mean, it's showing how sick it is there. Like it's so sick that the 3 month, the reverse repo is safer than the 3 month. So it's showing that the the market is super sick. Right now, we're kind of at a breaking point in terms of the reverse repo compared to the bond market. It's kind of insane, to be honest. Let's try with the yield. Yeah, it's positive. But 3 month Fed funds minus. Oh, I got it backwards? Okay, this is in the wrong area. I don't know why I stuck this over here. I gotta go down. Here it is. All right. So this is the 2 year minus the reverse repo, and I drew a line in the sand for when we closed below on the quarter for 2018 when things were starting to get sick. And here, I mean, technically, if we were to move it forward, this quarter came close. 2019, January 2019, and then this next quarter below here, April 2019. I guess it took a couple quarters before it was just acknowledged that things were sick, and then it spiked down heavily. But yeah, like 2 year minus reverse repo, it's negative spread, and then let's see, 2019, and then we have this spike for 2020. Um, Here we're testing that lower range, and 3 month minus reverse repo is negative, so that's pretty bad in terms of from the bank standpoint. Like things are just fragile right now. I don't know. Like that's kind of what this is saying in comparison to reverse repo. Reverse repo is supposed to be the most pristine collateral, and then next are supposed to be bonds. But people are so risk off on the bonds as far as like banks. Because reverse repo is the view from the lender, so there's a lot of seeking for safety if reverse repo yield is higher than the 3 month, right? NFCI, I don't know. We're kind of bouncing in between the gray box and not in the gray box. Consumer sentiment is still weak. I mean, we've been going up a little bit, but not by a lot. We are entering this fake out zone, but we are taking out the lowest close of demand, the demand zone. And so that's saying that consumers are, if we close the quarter below this, it's saying that consumers are more scared than the lowest demand within, I guess, last year or maybe last 2 years. I think that's about right. Within the last 2 years, uh, consumers are more scared than the last 2 years' lowest demand. Manufacturing production minus inventory, they were not at '08 levels, but it's really considering it. I mean, we haven't really moved. 3 month, 10 years, heavily inverted. I think right now it's down to like the 3 month minus the 2 year. Let's see if we can. So, yeah, I think we're inverted. We're above zero. We're right at zero. Last time that inverted was 2019. So isn't that crazy? Like the 3 month and the 2 year is inverted. I don't know. I think that's wild. Let's see if I can get this here and just bring it up. It's just saying that things are super sick on the fundamental level. Let's see. Yeah. 2 year. See, 3 month. Oh, this is reverse repo. We want to bring this down here. So this is 3 month, 2 year, 3 month minus 2 year, and we are inverted. Let's get it at the 0 line here. Oop. 0. Lock. Yeah, we're a little above it. We're a little bit above the 0. We've already tapped it. So we inverted on the 3 month and 2 year. That's wild. 3 month, 10 year, heavily inverted. 5 year, 30 year, inverted. 2 year, 10 year, definitely inverted. And then credit spreads. Credit spreads are bouncing off resistance here. We're going to wait to see how we close in the quarter. That close on the quarter is really going to be significant as far as like the future like direction. So, I mean, we're coming to the quarter, 6 month close, 9 days. So these closes are going to be really significant going forward just because it'll really embed that resistance to where it's kind of undeniable that we're headed in the reverse direction. And then junk versus TLT, we're kind of a little bit above previous quarter high. So we're going to wait and see. Lumber versus gold. So lumber prices are falling like a rock. The ratio's fallen like a rock. We didn't really check the lumber prices, but we can look over here. And it looks like it's pretty low. It's below the last week low. It's really depressed. That's all we could say. So moving on, but lumber to gold, like it's so bad that we could have a 6 month close below this band, which is going to show us a larger trend. But last time we were just even below this 6 month or 3 month band. We hit the COVID nuke 2020, so like this one feels like it's getting worse. It's like the I don't know. It looks like we'll go make new lows because just because it's the way it looks like it's going. I don't know if this low is gonna hold, but it's really low as far as lumber to gold. A lot of seeking for safety in commodities, and I wouldn't be surprised if gold pumps and does well. That's why I dumped my GLL, but yeah, we'll see. Just because I wasn't sure, I'm bullish gold. I just don't want to buy it now, and I think there could be some further downside now. Base metals versus precious metals. Precious metals are starting to gain strength here. We were speculating this would be resistance, and when it was up here, it was just really uncertain as to what it was doing in the first place. But finally, it respected the moving average channel resistance, and precious metals are starting to gain over base metals, showing risk off in the metals. So we have risk off in lumber to gold, and then copper to gold. Basically, we're getting some risk off sentiment in there. So commodities are really echoing the sentiment as far as, I guess, from a manufacturing standpoint, and just the overall fear in commodities. And then consumer risk, the survey and the manufacturing production, it's reflecting risk off there. It's reflecting risk off from the lender standpoint of view, the banks. It looks like it's over, too much risk not enough credit kind of conditions. It's too early to tell, but it looks like it's kind of near that box. And then as far as like the treasuries, like I mean, when the 3 month and the 2 year, when the 3 month is inverted from the 2 year, it's pretty bad. And when the 3 month is inverted from reverse repo, that's really bad. We just have credit spreads. Credit spreads are held up for some reason, and it's just a waiting game. And but for the most part, everything is sick. There's like every kind of red flag that the economy is sick is like flashing in terms of like these pairs or these comparisons. Obviously we're not looking. We got some kind of Fred data, which is the Treasury yields and the reverse repo. But in terms of like lagging indicators like unemployment, all that, like we don't usually use those, but we kind of consult them later because it's lagging. It's like the last thing to consider, but it's something we're waiting for to come down, and it is slowly trying to come down, I guess, but not really. And then so that's the move index, and I don't know, like we've kind of come close to the 2020 high on the fear of the bond index, and we're going to close the quarter elevated. So I don't know what that implies exactly, but there's a lot of fear in the bonds. I mean, when the 2 year the 3 month is inverted from the 2 year, like that makes a lot of sense, right? So overall, from the macro standpoint, macro outlook, we didn't look at any lagging data like unemployment or credit cards or anything like that, but we looked at enough, whether it's the credit market with Eurodollar futures or pretty much the other credit market with U.S. Treasuries or reverse repo, the standpoint from the lender and just how hedged they are against uncertainty and risk and wanting to be safe and liquid. Even from the treasury market, even like from like the 3 month bill, it's kind of wild. So like the fragility is real, all the way from the lender to the consumer and to commodities. It's just kind of wild just looking at the macro outlook, and you have to wonder what's gonna when things are gonna fall apart, what's gonna happen. But the macro outlook doesn't look good, and I don't trust any bullish pump to the upside. So that's pretty much the macro outlook. Thanks for watching.